joined now by Dinshaw Irani, Helios Capital Management Private Limited. Dinshaw, great to have you on the show, as always. And I think this becomes a key question. Once the couple of days of euphoria that Trump tariffs will not hit as bad as expected kind of ease, or before the next announcement one way or the other, what is the reality check that we need to be prepared for in terms of Q4 numbers?
Thank you first for having me on your show, and a very good morning to you, your team, and the viewers. So here goes on tariffs. I mean, I'm as, I think, clueless as probably President Trump is about the same, because every day something new comes up, and every day it's like a riptide hitting you from any direction. That's what I feel. This is what the market is doing. But I'll probably take away. See, the equity markets are very emotional. I mean, they go with the news of the hour. But I think the more mature markets like the forex market or the debt markets, I don't think they're getting swayed so easy. I mean, you've seen the yields in the US. They did correct a bit. They're strengthening again. The US dollar, if anything, with the tariffs. I mean, economic principles say that if a country imposing tariffs should see this currency appreciating, it's working the other way around, because everybody is taking a call that if US goes through with this, it's going to be a very stagflationary kind of environment, not only in the US, but also globally. In fact, US may see a recession and a high inflation. So I think that is where the problem lies. Frankly, I mean, these whipsaws that you see in the market, as I said, equities are very emotional. I think they get carried away by the news of the hour, but no, I don't think we're getting carried away. We had raised some cash. We remaining in that cash. In fact, it was 10 to 11% odd across our portfolios. We're not in a rush to invest. We raised it because we felt that it's better to cash out on certain sensitive areas and probably wait it out the high PE names that we felt the growth rates were coming off. We cashed out on those areas, and we're not in a rush to deploy as of now. Probably we'll do that when we see some stability coming back.
Dinshaw, I'm just wondering that what is the safest kind of way to trade right now? And how are you treading these waters, especially when it comes to deployment? The good thing is that even though SIP numbers have come off a bit, they've been replaced with ETF, it's not like domestic investors are running for the hills. So that's a good thing. But what is the sort of safe middle path to tread? Is it domestics? Is it banks? Is it more, consumption-focused stories?
So basically what we're doing is, and that's why we said that we cashed out on certain areas, was mainly those which were export focused. We didn't want to take any chances there because we know the tariffs are going to hit them like immediately, right? I mean, not only that, even the sound bites of tariffs coming out, and frankly, all these names were fairly stretched at some point in time. So that's why we cashed out on those names. But having said that, even the plays that we're playing with, I think if this uncertainty continues, basically I'll call it a place to hide right now your money, because frankly, I mean, I don't think there's enough places to hide anyways, because even if this uncertainty continues over a couple of quarters, you'll see even those areas getting hit. Like we like banks and we like financials, where we upped our weight, and we are more of 41, 42% in those kind of in that particular industry. And there again, it's mainly the private sector where we are, because we've seen that in times of uncertainty, it's the public sector banks, the lenders I'm talking about first. The public sector banks are the ones which really get hit because of the rising NPAs as such. And the private sector are much more prudent because they're on a short cycle basis, and the systems are quite quality conscious. I think the asset levels are fairly quality high as such. So that's why we selected those. In terms of NBFCs, again, I'm just referring to the lenders right now. In terms of NBFCs, we are fairly comfortable with those which are high quality names, right? Again, NBFC should benefit in a falling interest rate cycle because they are the first beneficiaries of a falling interest rate. They are on short cycle on both the lending as well as the borrowing side. So that's why they benefit immediately. Their names don't get impacted as much as the bank arm gets impacted. So that's why on that. On the services side, again, we are avoiding anything to do with equity markets. I think seeing the choppiness, the volatility, I mean, as in I'm talking about basically the guys who are TMAT guys. I mean, the RTAs and stuff like that. I think there'll be a lot of competition there happening in terms of rates getting negotiated and stuff like that. So that's why we are avoiding those on the services side. We are very comfortable with money managers, with wealth managers, because I think that's where the real growth will lie if the per capitas move up, and we will move up on the per capita. In fact, one thing I want to add out here is whatever happens with this tariff war, I think India will come out a clear winner, but that will be after a lot of blood has been let. There will be no, actually, as I said, that the winner will be the one who loses the least, right? So that's what's going to happen in the case of India. I think we lose the least as compared to what the world will lose. So that's why we believe we'll be winners. Again, another place to hide for us is healthcare. I think hospitals are going to do phenomenally well for the next couple of quarters, given the kind of bed additions, the RPOBs improvement and stuff like that they're going through, and quality is quite scarce in that area as such. Quality rooms rather are quite scarce. Same holds good for the hospitality sector. That again we like a lot. I think there again the ARRs and all the way they're going, I think it's phenomenal. In fact, anyone taking a vacation of late will be swearing by the fact that things have doubled literally out here. So that's what we like. So there are very limited areas where you can really park your money. And again, as I said, it's the next couple of quarters that will be insulated to that extent. But if this continues, there'll be no places to hide anymore.
Dinshaw, that's an interesting point that you're making, taking into consideration an absolute strategy shift right now to take into consideration the volatility and the uncertainty that we are seeing. However, you're saying if we have to focus on the domestic-oriented sectors, the next important thing that we need to talk about is the earnings expectation. And yes, higher single digits is what is on the cards in terms of the fourth quarter. But what happens in terms of the first half of FY26 also becomes absolutely crucial, because if the expectation is low, to add to that, you have a cherry on the icing with the tariff concerns and the impact of tariff that comes in. How much further downside that can be expected, in terms of export-oriented sectors, number one? And do you think your domestic-oriented sectors then will continue to shine?
Okay, just before I joined live, I was listening to the quarterly numbers that you guys were giving out. Frankly, we've done our own analysis, and I don't think we're gonna be in the high single digits kind of an area in terms of growth in the Nifty 50, I believe. I think will be very low single digits. I mean, look at the sectors there, right? Apart from probably banks and financial services, all other sectors will more or less, obviously healthcare, which is a very small portion, hospitality again is a very small portion. But apart from that, all other sectors will disappoint. I mean, be it consumer durables, be it staples, be it IT. I think IT will be a big disappointment. I think the first one who will start giving guidances will probably be Wipro, which comes out next week. By the way, ISG had their call over the weekend, and they came out with very disappointing numbers. I mean, they're the biggest consultant in the IT space today, and they said that the discretionary spends are getting delayed. The growth rate that they're projecting has come into a negative territory from 4.5%, which they predicted at the end of December. Now it's come down to -2.5 to 1% plus or something. That's the kind of guidance that they've given for this quarter as such. So it's obvious that things are really deteriorating out there. In fact, on the TCS call, the management was very clear that till Feb things were okay, but March things just went off the cliff as such, and haven't improved going into this quarter either. So I think there's a lot of uncertainty lying out there. So as I said, that I don't think the results will be the ones which will prop up the markets. I think the whole commentary out of US is what one should be tracking. And as I said, that look at their VIX, look at their the volatility on their bond markets. I think those are the ones that one should be tracking on a regular basis to realize what really is happening out there. And then things are not that great. I think one of the reasons why the tariffs were deferred were because the long-term bond yields moved up beyond 5%, and that really panicked the system as such. All said and done, the US survives because the USD is a currency of reserve, and if that comes under a question mark, things will not work out too well as such. So I think I'll leave it here. I don't even want to predict what's going to happen in the next couple of quarters.
So Dinshaw, then how is the exposure to your long short fund here? Because you've already reduced it from, I think, 65% to a 50%. Where does it stand now? Because that will give some bit of an idea to investors as to what side of the portfolio you should be going towards.
It's gone down to 43% now, and I think we are still not clear on what to do next. Maybe it'll go down further. I don't know. I mean, so I'm leaving it open right now. So,
Dinshaw, how are you factoring in what's happening with the dollar? So dollar, crude, and the whole commodity story, if I add in gold as well. But what we haven't seen for a while is a dollar showing a weakening trend line. And if that continues, how do you see that picture changing?
well, it already has weakened to an extent in the sense that rupee hit a high of 88 and it's come back to 85, 40, 50, 60 or something, if I remember right. But the fact is, by the way, there's one silver lining of this whole thing, of this whole weakness in the dollar business as such, because RBI has now got a real leeway for cutting rates aggressively. I mean, inflation is not a problem in India. So that is the only silver lining that I see as such. And frankly, I mean, RBI was all the time worried about the way the rupee will behave vis-a-vis the USD if they start cutting rates aggressively or releasing liquidity in the system. Let's not forget the whole demand crunch which came was because of the paucity of liquidity in the system and the cutback on lending and stuff like that, right? So if this happens, you may see some uptick, but once again, as I said, that it's all short-term driven, because if the globe suffers, if the world suffers, see already US is 25% of global trade, right? China is another 20-odd%. So you're talking about roughly around 40-45% of global trade coming under question mark if this war continues between US and China. And I think the whole war boils down to these two big nations as such, and I think we are on the sidelines looking for that. So I think that is one area. In fact, because of this, say, loosening of purse strings by the RBI or cutting off interest rates, we are fairly comfortable with the interest rate sensitives as such, but not the auto space. Frankly, I mean, I think the auto space is done and dusted here because if EVs come in, there's a big question mark again on that space. And on the lending side, I've disclosed what we've done. Oil and gas, I think the downstream guys looks very interesting because given the way the crude has come off, and whether the reason for crude coming off is not only because OPEC has increased their production, but also to bring in line their members, but also because I think the world is now questioning the global growth. And that's why the way the crude has fallen is the reason here, which is not too healthy. Again, as I said, a couple of quarters.
Reasons for crude coming off are not healthy, even though it's good for the Indian economy, and dollar maybe in the same tone. But thank you so much, Dinshaw, for speaking with us. By the way, compliments on your glasses. Notice them, they were looking very funky.
By the way, since the time I started wearing these glasses, the markets were in the up move till the tariff war happened.
Keep them on. Keep them on. We absolutely insist.
The other side also should probably should have the other side as white as well. I think probably if that could help for a further upside.
Let's not change anything. I would say let's not change anything at this point. All right. Thank you, Dinshaw. Always a pleasure.